Okay, in this mini lecture now, we're still going to be working with accounting data, but this time we'll work with this data. And here our situation is different, where very typically when a company has its financial records audited, the auditing firm will try to verify the accuracy of accounts receivable, okay? It's tempting for sometimes a company to overstate how much money its customers owe them. So part of the audit process is the outside auditor will try to verify that that accounts receivable are accurate. So what we did here was the auditor came into the company and pulled the records on 24 customers. And so you can see here for customer number 1, the company claims that it's owed. Let me see if I can make this a little bit bigger. Yeah. So for customer number 1, the company claimed that it was owed $1,257. For customer number 8, the company claimed it was owed $5,757. For customer number 17, the company claimed it was owed $23,892. So the auditor took this information, okay? The auditor took this information and contacted each of the customers and said to each customer, how much money do you owe this company, okay? How much money do you owe this company? And these are the data here for that, okay? So in the case of the first customer, the company claimed it was owed $1,257, and the client recognized that it owed $1,257. In the case of customer number 5, the company claims that it was owed $21,365, but the client says that it only owes $19,219, okay? And it's not like the auditing firm wants these two values down here to be equal, okay? The average amount owed as claimed by the company is $15,184. The clients on average claim that they owe $15,608. It's not so much that these two values have to be equal to one another, but they have to be close, okay? They have to be close. So now we're confronted with the situation of, well, which inferential statistics test would we use? And if you'll recall in class, we talked about doing it as a one sample difference of means, a two sample difference of means if the groups are independent, or a paired observations test. And I would argue that the way we've structured this data, that the paired observations test is the best way to go. Because for customer number 1, we can match up both scores. This is how much the company claims it's owed. This is how much the client claims that it's owed. For customer number 10, the company claims that it's owed $25,980. The client claims that it owes $15,980. So since we can match something for company 1 in each of the groups, I'm inclined to use a paired comparisons or a paired observations test, okay? So we're hypothesizing our null hypothesis. We're hypothesizing zero difference between the two groups. And our alternative hypothesis would be that the average difference is not zero. And technically what we're saying here is, if you see this number 2,576, we're really asking the question, is 2,576 statistically different from zero or not? Okay? So we'll run the paired comparisons test or paired observations. We click on add-ins. We go over to Megastat. We click on Megastat. And we drag down to hypothesis tests. And we'll go over and down to paired observations. Okay? And it doesn't make any difference what you use for group 1 and group 2. But remember to highlight the column header and all the data, but don't highlight the descriptive stats at the bottom. We do the same thing for our second group. I'm going to ask for the 95% confidence interval. We click on OK. And here we see we've got a small p-value. Okay? So we conclude that the two groups are not equal to one another. We conclude that this observed difference of $2,576 is statistically significantly different from zero. Okay? So I'm going to close off this mini lecture, but I'm going to come back and do some more work on this because there's a couple things I want to share with you to help reinforce not only what we're doing here, but a couple of other things about the difference of means tests. Thank you.